Hi, I'm Ben Shepard, and I'm the editor of Lewis Rukeyser's Mutual Funds. And today we're joined by Neil Hennessy, Chief Investment Officer and Portfolio Manager with Hennessy Funds. Neil, thanks for joining us today.
Thanks, Ben.
So just to start off, we're up more than 50% since the March 9 lows. Do you really see this rally as being sustainable, or is it losing steam from here?
No, I think it's sustainable. In fact, I've been telling the story that I really think that we're in a 10 to 15 year secular bull market. And people think that I'm crazy to say that. But let's just look back and see what happened here. When the whole market cracked, it cracked in September, October, and then November. And what happened in November? The Treasury injected $250 billion into the banking system. Although Barney Frank and Nancy Pelosi were saying that money should be lent out, it wasn't to be lent out. What it was to stabilize the banks. And by doing that, it's no different than breaking your wrist. You go to the doctor, they put a cast on it, and that's to stabilize it, not to heal it overnight. And then a recovery process takes. And the recovery process has taken place. And you're seeing the banks get healthier on a daily basis. And so when we got to the crisis of confidence in late February and March, early March, it was unprecedented for me. I've been in the business 30 years. People were calling me up, Ben, and saying, Neil, just get me out. I know it's not your fault. Just get me out. Whatever I have left, I have left. And you couldn't blame them. It was simply that they lost 50, 60% of their investable capital. And at the same time, what they had in their hip pocket, which was equity in their house, was being diminished. And it was just crazy. But at the same time, if you step back and took a look at it, historically, you know that we use price of sales to find value in the marketplace. And on the Dow Jones, historically, it's traded around $1.20 for a dollar in sales. On March 6th, you could have bought $1 of revenue in the Dow Jones for 60 cents. And the market's now come back 50%. We're still 40% off the high, but we're back in the norm now of where we should be on the price of sales. The difference is because the Dow is right now about $1.20 for a dollar in sales. The difference with it, Ben, is sales are way down. Any incremental increase in revenue is going to drop to the bottom line, and that's what's going to sustain the market going forward.
The consumer confidence numbers are ugly. The employment situation appears that it may be stabilizing, but it's really not improving. What's going to drive the revenue growth going forward?
Well, first of all, let's look at unemployment. It's starting to stabilize. It's starting to flat line in there. Second of all, orders will start to pick up little by little, and somebody's going to put in an order at some point in time, and they're not going to want to wait 6 or 9 months for it. So whoever has the order is going to have to hire some people. But most likely they're going to hire them temporarily at the beginning and then full-time going down the line. As for the confidence, you can't blame the confidence being down. Housing, their equity's still down, right? They're still not even from the high on their investments. And I sort of look and I said, well, it doesn't shock me that it's down, especially in light of what's happening. You know better than I, but almost 100 cents on a dollar that's going into mutual funds today is going into fixed income. And you're looking at a 30-year U.S. government guaranteed bond is paying you 4%. And you could buy the whole Dow Jones, all 30 of those companies, and get a 3% yield. So if you had to bet your net worth, Ben, right? If you had to bet your net worth, are interest rates going to be higher in 5 years or lower than they are today?
Safest assumption I would say would be higher. So given that, what's kind of your viewpoint for inflation going forward? Do you feel like the trillions pumped in is an inevitable recipe, or can it be avoided?
Well, I think we're going to have inflation in the future, but I think it's going to be constrained. I think Chairman Bernanke's done a wonderful job in road mapping this whole recovery. And his biggest fear is deflation, but he's not going to allow inflation to get out of control. And so I think that there's going to be pricing power, but it's not going to be on the upper end. It's going to be on the lower end of the scale to the consumer. And I can explain that more if you want me to.
Well, yes, given all of that, let's talk a little bit about your Focus 30 fund. It's very data-driven from what I understand. Can you kind of explain the process used there?
Well, primarily it's a formula, but every manager out there, Ben, has a formula. We just stick to it. It's highly disciplined. The reason the Focus 30 works is because of the transparency, the discipline, the repeatability, and the consistency. And when you take those 4 factors and you put it into the Focus 30, what do you come up with? Number one, you come up with a great fund. But other than that, what every year when we rebalance it, it gives us a new idea of what's going to happen in the short term, if not the long term. So for instance, the formula is very simple. The companies have to have a market capitalization between $1 and $10 billion. No ADRs, strictly U.S. company. Second is the price to sales ratio of 1.5 or less, because we're not going to pay more than $1.50 for a dollar in sales. Third is to make sure that the earnings are higher than the previous year. And fourth, we want to make sure that they have positive relative strength or price appreciation, the stock itself, over a 3 and 6 month period. And then simply we buy to 30 companies in equal dollar amounts with the best relative strength or price appreciation over the last 12 months. Hold those for approximately a year, and then refresh or rebalance the portfolio.
What's the reason for the 1-year holding period?
Well, when we went back and looked at history, because history tends to repeat itself all the time, so we just went back and we did some back testing numbers, and we did 6 months, 12 months, 18 months. And it didn't really make a bit of difference on returns. One of the short term you're going to have a problem with because of trading costs or whatever. Longer term it didn't make a difference. So we just looked at the 1 year thereabouts, and it worked phenomenally.
Why change it if it's working?
Exactly.
So